Herr Gruber, Peter Semler,
Hey.
Capital Intelligence Group.
Hi.
Allianz Group has been one of the most dynamic investors in emerging markets. You're doing Islamic finance in Russia, one of the things in Africa. So, how's your return on investment? I mean, sometimes risky markets are less risky than, let's say, Greece or what people would think would.
I'm sorry, I need to get
Yeah.
sorry.
Yeah. So, on the return on investment on risk reward for Allianz, these emerging markets, growth markets in Africa, whatever.
See, at the end of the day, the mix of the portfolio has to work out.
Yeah.
Our portfolio is structured like a pyramid. We need safe investments for stable returns for our clients to cover the guarantees, and then we can add layers of risk step by step. And let's say emerging market investment, illiquid investment, loan type of investment are on the upper layer of the level. So it's not doing the one or the other. It's doing building a portfolio overall which is relatively stable altogether. And as I said on the podium, you have to understand the risk of the single investment. It's not about high risk or low risk, just to understand the risk, and then you can adjust it in your portfolio. And obviously, the higher the single risk is, the smaller is the proportion in your portfolio to diversify this broader.
We find that many of the big banks or whatever, even insurance companies, misjudge the risk. They believe these risks are overblown. Sometimes they look at risk that's in fact less riskier, say like a power project that's being guaranteed by the IFC or the EBRD, and then they invest in like equities in Kenya that have been overblown on price equities. So it's mainly the skill in judging the risk.
Yeah, but that's exactly what I meant by the difference between risk and uncertainty.
Yeah.
You really have to understand your risks. If you don't do this, then you have a problem. And by understanding the risk, you have to diversify the single risk drivers. So it only works if you have uncorrelated risks or lowly correlated risks.
Yeah.
You know, if you do a lot in one country, it's always kind of correlated, even if it's different sectors or bonds and equities or whatever. There's always the country environment. So understanding the risk but diversifying and as much as possible low correlation in the investment, that's key. And if we look at the defaults we have seen in some of those areas, let it be the financial crisis in the US or let it be emerging markets, it's always that there were too many investments in a single area.
In a single area.
Mortgage and
Subprime or
subprime, you know. So it's all about diversification and understanding your risk.
Okay, thank you, Mr. Gruber. So you're based in Munich?
Yes.